Hey everyone, welcome back to my channel once again. This is your friend Abhishek, but not a financial advisor, and here I am with another interesting video for you guys on demand, which is the 3 stocks which I'm buying for the year 2024, or which I already bought in 2023, but I'm continuing to buy them for 2024 as well, because few of them are still at a fair value according to my assumptions, in my opinion. Okay, so this video is another Cassava Sciences. No, I'm kidding. This video is not a Cassava Sciences stock update video. So for all those Cassava Sciences stockholders and fans, I'm sorry, but I had to make this video as well because this video was on demand. And like I said in my previous videos as well, that I'm doing this because I love this. Plus, I want to feed you guys with the information and the things which you also want to see, because this is why I'm here. You know, I'm not doing this because I just want to show you guys what I would like to show. No, because also I'm here for you guys and serving the community. So of course I would love to make videos on demand, and that's what I'm doing. Yeah, and that's why here I am with another video of the 3 stocks which I'm buying right now. And those are not Tesla, no NVIDIA. These are not those giants which you always hear on other YouTube channels and this and that. So these are some cherry-picked stocks based on the evaluations and based on their fundamentals. So that's what I would be covering here, the 3 stocks for the year 2024. And this might be my last video for the year 2023. So I wish you guys a very happy new year, and I hope that you guys had a really good Christmas and you're enjoying these holidays. Yeah, if you have this bridge holidays, I don't know, and if you do, then yeah, I hope you're enjoying this time with your families, and I hope you will enjoy this video as well, to just learn new things and to enjoy my valuable content which I think it is, but okay, that's just my opinion again. So yeah, again guys, this is not any kind of a financial advice, and without further ado, let's just jump right into it. Okay guys, so the first stock which we are going to talk about is Valuation. Now, I don't know how many of you guys have heard about this company, and this is a company which many people have not talked about. So as you can see, Valuation AB engages in development, production, marketing and licensing business, or to business casino solutions, yeah, to gaming operators. The company is headquartered in Stockholm and is currently employing 13,000 full-time employers. Okay, so of course the industry is online gaming, hotel, restaurants and leisure, casino gaming, as you can see. Yeah, and of course it's a consumer cyclical sector. Okay, so the market capitalization currently is at $23 billion US. Here you can see in Swedish kronas, so conversion, and it's approximately 23 or 24 billion dollars. And the performance of the stock has been phenomenal. So since it got IPO'd, which was in 2015, it has grown by, the stock price has grown over 6,000%. Okay, so the company was IPO'd in 2015, so the stock price has grown by 6,000%, which also actually mean that the stock price has grown approximately by 60% at a compound annual growth rate per year, which is phenomenal, guys. Now you guys must be asking me, then why are you are picking up this stock which has already grown by so much? Well, the same answer would be like, why are you still buying Tesla which has gone by 10,000% or something like that? Okay, so because the company is still growing at a really phenomenal rate, and I will jump on to that in a moment, and you guys will definitely understand why I'm buying this company, and it's still actually a bit cheaper, on the cheaper side in my opinion, with my assumptions. Okay, so yeah, as you know that it's a B2B solution company. So let's jump right into the financials, because there are 3 companies to cover in this video. So I would like to keep this as short as possible and cover only the most important things. Yeah, so let's jump on to the income statement to see the revenue growth of the company. And if we check the revenue growth since 2015, when it was let's say IPO'd, yeah, so 2015, and if we just click onto the percentage, so we can see that the company has been growing at a compound annual growth rate of approximately 50% average. And now let's see the net income, because we would like to see the profitability. So if I click on the net income, and we can also see that the net income has also been increasing quite dramatically, and approximately at 70%. 70% is huge. And that's why I said that the company is still growing, guys, and that's why I'm buying this. And therefore, let's say if I want to see the diluted earnings per share, so earnings per share, you can see huge growth. Again, approximately, you see 40% from 2015. So percentage change is approximately 40%. So 40% increase in the earnings per share. Again, huge. Okay, now let's go on to the margins, because this is one of the important metric which I would like to see, and that would be in the metrics. I would like to see the operating margin, because this is the margin which actually tells us if the business is efficient or not. And we can see that the operating margin has also been growing quite nicely. So if you go on to 2015, since it got IPO'd, so the value has become from 27% to 62%, guys. So we can see that the operating margin has been able to grow dramatically as well, almost from 11% to 26%. Yeah. And now if we would like to see if the business is more efficient, I would like to see the return on its capital. So return on the invested capital, and we can see that the return on the invested capital, okay, in the past it was quite dramatic, but now let's say since 2020 it fell down, but again it's increasing back. So it's good. Business is becoming efficient. And if we just take the average, so the average is not that bad, you know, so it's around 15%, 16%. Yeah, something like that, 92%. Yeah, something like 15 to 16%. And this is good. Like average is 17%, like S&P 500 yields around 8 to 9%. So 17% return on invested capital is, again, that points out that the management is quite efficient. Yeah. Now let's look into the balance sheet quickly. So let's have a look at the balance sheet. So we can see, so the total cash is sitting at $500 million. Okay, so the current assets are sitting at $1 million. Total assets are sitting at $4 million, and total assets incomplete are 4,369,000, and total liabilities are sitting at just 900K. So yeah, it's really good. The balance sheet is quite amazing, and the current ratio seems to be above 2, which is huge, which is really good. Really good balance sheet, I would say. And now let's go on. So there are many other things which I would like to show you guys, which is like how is their scalability and the intellectual property and switching cost and blah blah blah, but it's that would make this video quite long. And yeah, but if you would like to know more in depth about these individual stocks, then again, leave a comment in the comment section. I would definitely make a video on these individual stocks, whichever you guys pick. And yeah, but for now, like I said, I would just like to keep it more simple and straightforward, so that you guys get the exact information why I am actually picking up this stock. So let's go on to the DCF model quickly. What I would like to project is for the next 5 years, and the metric growth rate I saw was around 20%, and I would like to be conservative. And yeah, they are actually diluting, so at a 3% outstanding, and I would like to keep the price ratio at 20, which is quite conservative though, even though the average is around 40. Let's see. So I would like to keep price to free cash flow metric here, and then let's see. So median is around 45, and we took 20 as our average. So that's, again, like I said, it's quite conservative, on the conservative side. So again, let's fill up these. So the metric growth rate is 20%, which is again conservative. Shares outstanding at 3, and the price ratio I would take almost half. And of course, the discount rate, at least I would like to get 10% higher than the S&P 500 if I'm investing into individual stocks. So as you can see, the fair value is 17% above the stock price, which at the time of recording this video is trading at, which is at $120, yeah, which is on, by the way, 27th of December. And the future stock price, from my opinion, from my assumptions, are will give me 88% upside potential, which is a compound annual growth rate of 13.5%, which beats my discounted rate of 10%. So I'm glad, I'm happy. And let's see what it has to do, Evolution Gaming has to do, if it has to reach the stock price. So it has to reach a free cash flow of $2.5 billion. Now, can it reach? I think it can reach with the compound annual growth rate at which it is growing. So yes, that's my first pick, guys. And now let's jump on directly to the second pick, which is, again, I don't think that you guys might have heard about this company. So this is the Toro Company. So before we jump on to the analysis, I would like to show you what this company is about. So just a quick introduction. So this is in the business of designing, manufacturing, marketing, and selling professional turf maintenance equipment and services. The company is headquartered in Bloomington and is employing 11,000 employees. So this is the industry's tools and accessories. So if we go on to here, and machinery, so you can see machinery, agriculture and farm machineries. So this is a company which you might not know about, and many of the investors might not even think about it, because this is a different sector. The price targets, don't go on to these price targets. It's okay to look at them, but just let's go on to my valuation model and you will see why I'm buying this boring company. Okay, so it was actually founded in 1914, this company, and it has been public since 1980. So it has a pretty good historical track record, and the growth rate has been amazing. The growth rate has been pretty amazing. And let's see that so it's on max, so we can see from $1 to $99. So I would say the annual growth rate has been around 15-16% since it was IPO'd, and it is of course outperforming the S&P 500. So not that bad. So what you would like to know or do is that whenever you cherry pick up the stocks, individual stocks, you should at least be beating the indices. And this is what you would like to do, and this is what I'm doing. Now again, you guys might be asking, then Abhi, why are you picking up this stock if it's already has been risen so much? Why are you guys? So I would like to ask you the same question. Why you guys are still investing in Microsoft, Amazon, Alphabet? Come on guys, because this is still performing nicely. Okay, so now let's go into the financials quickly. And let's check the fundamentals. So income statement, and we can see that the business is growing. We can see the business is growing quite nicely. And if we check some metrics, which is quite important, so we can see, so this is kind of a developed business, so I would still like to see the gross margin. And if I see the gross margin has been steady, let's say. It has been steady. So here we can see the gross margin has been quite decent, 33% in the 30s. So basically good. The business is quite good. Let's say a business for over 30 years and maintaining a gross margin of around 30 to 35% is not that bad, guys. Really not that bad. And it has seen slight improvements in the past, but again, it has been okay. And now let's see how efficient is the business. So how's the management doing? So return on the invested capital is really good. Like average, if you see 20%, 30%, 30%, 33, 39, 38, 29, 37, 42. Let's say an average of around 25, 26%. It's not that bad, guys. Again, it's amazing. So I see that this is going quite good. And the operating margins, as you can see, again, 10 to 12%. For a business in this sector, which we don't even think about, is quite impressive, guys. Is quite impressive, no doubt. So now let's talk about the balance sheet. So the current assets are sitting at $1.6 million, and let's say the current liabilities at 1.0, so almost $1 million. So it's good. It's still over 1.5, 1.6. So it's not that bad. That is good. So this is quite good. And again, guys, like I said, I would like to keep this video as short as possible because we have to cover 3 companies right here. So I'm not going too much in depth. And if you would like to know more about these companies, then of course you can ask me in the comment section. That's what the comment section is for. Now let's just jump quickly on to the evaluation model. So we know that the company is generating profit. The operating margins are quite good. The return on invested capital is good. So the management is quite efficient. Now let's see what I see in this company, that with my valuation expectations and assumptions that I'm investing into this company. So now let's jump on to the DCF evaluation of this company to see why I'm buying this company. So I will pick up the metric earnings because that was in this case, in this company, more realistic, because we still have to see how the operating margin is going to improve. But we know that the earnings are definitely increasing quite linearly. And since this company is already so advanced, more mature. So in this case, I would take earnings as my growth rate or evaluation metric. Yeah, and we know that the earnings were increasing at a much faster rate, but I would keep it at a conservative side, and I would keep it at 10%. And Toro is already maintaining an earnings growth rate of around 10 to 11%, so I will keep 10%, for the next 5 years. And shares outstanding, they're buying back shares at minus 1.2%, but I will keep it on the more conservative side. And price ratio I would keep of 26. It's still conservative, but let's say for such a mature company, I would still say it's okay. I would not put more than this. And we see that the fair value is sitting just at the current price, at almost the current price at which it is trading right now. And to see what it has to do to achieve these price targets is that it has to do an earnings of around $600 million. And it was already doing an historical earnings of $517 million. So I do think it can reach up there, and it doesn't have to reach just next year, but in the coming 5 years, and we will still be beating our discount rate of 10%. Now, if we just say that if they can keep up this growth for the next 10 years, then you will see we have a remarkable growth here. So for the next 10 years, 10%. And the price ratio has automatically gone down because for the 10 years it's too much, 26 let's say, so let's keep 25, and we can see that we are again beating the discount rate of 10.21%. And that's the reason, guys, why I am buying the Toro Company. Now let's jump on to the third company in this list, and that is gonna be Paycom, so from the fintech sector. And now you guys might be asking me, hey Abhi, why you're buying Paycom? Okay, so for Paycom, I would like to show you guys first of all. Okay, so for Paycom, we do have some upcoming catalyst in the year 2024. I hope so. So first of all, Betty will act as a growth headwind over the next year. Paycom trimmed its full year outlook and now sees revenue rising 22% in 2023. And that's down from the 24% growth rate expected this year. Meanwhile, it expects growth to slow further in 2024 to a range of 10% to 12%. However, the company continues to invest heavily in innovation, sales, and marketing. Those investments should help accelerate growth in the future. For example, Paycom. So the company Paycom continues to reaccelerate growth in the future. So Paycom continues to launch new products. And the other thing is, Betty has become a major cost saver for Paycom's clients, so much so that it's starting to cut into some of the incremental revenue the company has earned from fixing payroll problems. So I am more bullish on Paycom because of Betty. So by the way, just for you guys who are not aware about Betty, so Paycom has helped revolutionize the payroll sector. It was one of the first companies to bring the industry online. It has since launched Betty, Better Employee Transaction Interface. That's the complete form of Betty, an industry first solution that empowers employees to do their own payrolls. Betty helps employees find and fix costly errors, saving companies time and money. So that's about Betty, and Betty is doing phenomenally well for Paycom, and that's why I am much on the bullish side for Paycom. So if we just jump onto the financials of Paycom, we can see that the business is actually doing quite okay, decent. I would not say phenomenally well, but it's doing quite decent. So we can see the revenue has been increasing quite nicely, an average of 30%. This is amazing, guys. And if we go on to the operating expenses, so we can see the operating expenses from the last 4 years has been continuously declining, which is good, which is what we would like to see as investors. And if we look into the cash flow, so cash flow was a bit of concern for me, but of course, because of the current economic situation, I digested this, same as like in the case of PayPal. And I do see that there are a lot of headwinds, but tailwinds will start in the year as soon as the interest rates will start lowering down. And I do think that these companies will really start performing quite good on the market, and people will jump into these companies. And that's why for now, these companies are actually trading at, let's say, a cheaper metric. The price to earnings ratio is at 34, which is quite expensive. I know you guys would see, but to be honest, it has come down to a really cheap value. And that's why I am buying, but not heavily, Paycom. I would like to see a price to earnings ratio of around 25, 26. like the forward price to earnings ratio, and this is why I jumped in, because the forward price to earnings ratio seems to be cheaper. So yeah, and apart from that, if we go on to the inside score quickly, and we will see that the next year projected EPS is 39%, which is huge, which is amazing. Yeah. By the way, forward dividend yield is quite amazing also for Paycom. And the Toro Company, by the way, also has a dividend yield. So it is also a really good dividend stock. I forgot to mention, the Toro Company has been increasing its dividend since it has not stopped its dividend, since 1990, I guess, and it has been growing the dividend yield by 10 to 15% year over year. So it's phenomenal, guys. It's amazing. Okay, and we can see the growth is quite amazing. Revenue has been increasing by 26%, the gross profit by 25%, operating income by 32%. This is what we would like to see. The growth. That's why I'm investing into these companies, for the growth. Now let's just jump quickly onto the DCF model. So I will take free cash flow here, and the metric growth rate I will pick around 20% here, okay. And the shares outstanding, unfortunately, they are diluting us at a rate of 1%. See, price ratio is giving me 100. This is crazy, but we already saw the price ratio is around, okay, we didn't see, sorry. So I will just show you guys, first of all, what is the free cash flow price to free cash flow price ratio for Paycom, so that you guys and I get an idea. And the median is sitting at 78, okay. The median is 78, latest it's 39, so it's quite low than the median, and the highest it has gone up to is 22, 32, which is crazy. Never buy a company when it's trading at such high price to free cash flow ratios, guys. It's crazy. It's really crazy. Let's go on to our DCF model once again, and we can jump onto the DCF model. And again, price to free cash flow, I will take the metric free cash flow, and projected years to project is 5 years, and I will take the metric growth rate around 25%. And like I said, they are diluting us, so 1%, and let's keep the ratio as 35, okay. So the metric growth rate is 20%, sorry. And discounted cash flow and the discount rate of 10%. So with the price ratio of 35, which is quite low, but let's say in the next 5 years we will not have a price ratio of 35, but so a price ratio of 30. Okay, so with the metric growth rate of 20%, which is still a bit on the conservative side, but let's say they try to get hold of the management and they can improve the efficiency, or let's go on to even 18%, then we can see that we are still at a fair value, just 2% below. So yeah, like I said, I would like to pay for a price to free cash flow of 30, and if I pay for a price to free cash flow of 30, which in my opinion is less, and when the economic conditions are improving and the interest rates are going down, I do think that it will be trading at a much higher price to free cash flow ratio, and I would get much better returns on this. So yeah, if I keep the metric growth rate of 18% and the price ratio of 30, and like I said, 30 is actually a bit on the conservative side. Now many of the value investors will argue with me that 30 is still expensive, but guys, we should not forget that this is still in the growth phase, this company Paycom, and like you saw for the Toro, I kept it a much lower, much lower, because that's a bit on the mature side. And for the Evolution Gaming, I kept it a bit on the higher side because that's still in the growth phase. Like you saw, the margins and the growth at 60% is not for a company which is matured, but for the Toro Company, I kept it lower because we saw that the growth rate is not as high as these companies. Okay, so I do see a much potential in the price ratio, and that's why I'm keeping it still on the conservative side. Like you saw, the median was around 70, so I'm not even at the half of that, so still keeping at 30. But I do think that when the interest rates will come down, or if not even down, but they become more stable and the inflation is coming down, then I do think that it can go much higher. So 35, I would say, is a much reasonable price ratio to keep for Paycom, a company like Paycom, and we can see that it is giving me a compound annual growth rate of 12%. And what it has to do to reach there is to generate a cash flow of $680 million. It's currently generating a $300 million. So can it double? Yeah, I do think it can double in the next 5 years, but of course all the tailwinds should work in favor of Paycom. So why I'm keeping up this bet? Because I do like to keep some stocks in my portfolio which are not fully speculative. So you can see this is not fully speculative decision. It is based on my assumptions, which are not that crazy, but this is also not more on the, let's say, Warren Buffett style of investing. So many value investors would definitely argue with me on this, but like I said, I'm not a complete value investor, but I do like to see at the fundamentals, and here the fundamentals do sound pretty darn good, especially considering that it can grow. So you can see here, like right now, annual free cash flow growth rate over the past 5 years was around 19%, and I'm still keeping them at 18%. So you can see my assumptions are not that crazy, guys. And over the last 5 years, the shares outstanding were minus 0.07%, and I kept it at 1% positive. So you can see that if I just change these things, 19%, and here if I keep minus 0.05%, you can see the stock price becomes crazy, and still I can keep at 25, and you can still see that the future stock price, okay, now it's below my 10% discount rate, but do you think that it will be trading at 25 for the next 5 years? If you think yes, then this company might not be for you, but I don't think. That's why I am buying this. Okay, so that's it, guys. I really hope that you guys liked this video, and if you did, then please hit that like button, subscribe to the channel. There are many non-subscribers who are not watching these videos, but are not pressing that subscribe button. Guys, it's just a single click for you guys, but for me it matters a lot. And if you would like to join my Patreons community, because these are the companies which I give out to my Patreons, to my private Discord members, with full depth analysis, then don't hesitate to join our beautiful Patreons community, and you will find the link in the description below. And again, guys, I made this video for you guys so that you guys can know what I'm doing, and I am always fully transparent. And again, this video was on demand, so if you guys would like to know more about more stocks which I pick or which I sell, then first of all you can join our Patrons community, and if you don't feel like, then no problem, but then let me know in the comment section down below which stocks you would like to know about, and I would definitely try to make a video on that. I will find some time and I will do that. So that's it, guys. Like I said, this might be my last video in the year 2023. So I really wish you all the best. You stay safe, spread that love, celebrate, of course, but with safety, with more maturity, with kindness. Show kindness to others and spread love, and keep on investing with free mind, but doesn't mean that you just blindly put your money anywhere. And I'm just a YouTuber. I'm not here to guide you. I'm not here to sell you anything, or make you buy or sell anything. I'm just here to give you the knowledge which I have, and spread that love and kindness. And I will see you next year. Okay, we'll try to make a short video for the New Year's, but if not, then I'll see you in the next year. Until then, stay safe, stay healthy, and ciao, and a very, very happy New Year, guys. Cheers.